Our next guest is taking a cautious approach still. Jeremy Zirin is the Chief Equity Strategist for UBS Wealth Management, and he joins us now. So Jeremy, what does caution mean to you when it comes to allocation?
Well, I think what we're seeing is that we expect to have a fairly range-bound market in the S&P for the next several quarters. So we think that this range, what we've been in for most of 2010, of around 1,000 on the S&P on the low side to 1,200, is likely to continue. We have a tug of war right now between reasonably strong earnings momentum, but valuations that continue to fall. And I think that earnings will be relatively supportive for the next couple of quarters, but comparisons are going to get more difficult as we get into 2010, and that valuation ranges, I think, are going to stay relatively low compared to long-term historical averages. And
you're underweight materials, industrials, and consumer discretionary. Let's talk about the materials there and commodities as well, because one takeaway from the Fed's conversation yesterday in terms of their statement was that inflation isn't there in a way that worries them at this point. They stand ready to pump more QE into the system. Some out there would say that means go out and buy safe havens like gold.
Yeah, I mean, we've seen weakness, some weakness in the dollar recently, and certainly the Fed statement yesterday added fuel to that fire. Broadly, I think, though, that this stage of the business cycle, when you start to see leading economic indicators start to decelerate, and most of our preferred leading economic indicators peaked in the April-May period of earlier this year, you tend to get a rotation from the cyclical areas of the market to the defensive areas of the market. So materials, consumer discretionary, industrials, all of those sectors tend to be more economically sensitive. Those were the sectors that were the biggest outperformers off the market bottom from March 2009 to the market peak in April 2010. We don't think those are going to continue to lead the market in a period of consolidation or range-bound markets. We think we've already seen a fairly strong defensive rotation into telcos, utilities, consumer staples, healthcare. We think that defensive rotation continues to have legs as economic growth just isn't supportive enough to boost the earnings power for some of those more cyclical sectors.
So what happens post-November? I mean, does it then become more about stock picking? What's going to be the trend that dominates? What are you going to advise people?
Yeah, I think probably the most interesting areas of the market right now are sectors and industries, companies that are have strong dividend growth prospects.
Yeah.
So if you look at where interest rates are right now in the 10-year Treasury, hovering around 2.5%, you have this very strong relative yield advantage for dividend-paying stocks, especially in the non-cyclical sectors. So we overweight consumer staples. It's currently yielding 3%. Over the last 40 years, consumer staples dividend yield has averaged half that of the 10-year Treasury.
Yeah.
Right now, it's exceeding that, and you're getting growth in that dividend. So at a multiple of around 13.5, 14 times earnings, you're getting reasonably priced companies, not so economically sensitive, and you get a strong dividend stream.
Yeah, dividend-paying stocks seemingly the positive or the popular safe haven, it would seem these days. Thank you, Jeremy, UBS Wealth Management Chief Equity Strategist.